All right. Hi, welcome everyone. Thanks for joining our monthly series, SRG Off Script. My name is Max. I'm our head of marketing here at SRG. We're going to go ahead and get started in just a moment, but before that, I have just a few quick points to share. Our dedicated topic today is going to be on building greater enterprise value. David's going to answer your pre-submitted questions, but please do go in and chat in those live questions as well. If we don't get to your chatted in question, we'll follow up with you via email. Our next SRG Off Script webinar is going to be scheduled for Thursday, February 9th. So you can reply into the original webinar invite that got you here today, or reach out to us on social media for topic recommendations. Finally, we're going to be recording this session. So we'll be sending you the link to this recording along with a few other free resources no later than Monday of next week. And I think with that, David, we have a good group of people still trickling in, so we could go ahead and get started.
Super. Thanks so much, Max. Appreciate you helping moderate and open us up here, and frankly, everyone for taking time out of your busy schedules to join us. So as Max mentioned, we get to go deep today on the topic of building greater enterprise value, something we frankly talk about a lot here internally for sure, especially with clients. But a lot of times we're at conferences, we do a lot of study groups, at PA meetings. It's a topic that comes up quite a bit in a roundabout sort of fashion, sometimes implicitly, sometimes explicitly. So we're excited to tackle your questions. So you heard Max mention it. There's the Q&A portion. We'll take those questions live. And don't hesitate to ask a question if it's a little bit more specific to you or your situation, or you're worried that it might be. Well, that's great. We just won't ask it here, or I'll sterilize it and ask it in such a way it applies to the broader group, but we will make sure we get back to you and follow up with you. Beyond that, we did have a handful of questions, a little over a dozen or so that were sent in ahead of time, more than that, but a lot of the same question asked in different ways. So I've got those already queued up. Excited to spend as much time as we can. Real quick, brief intro. If you don't know who Succession Resource Group is, thank you for trusting us and registering anyway. And if you're generally familiar, I'll try to fill in some blanks for you. So we are a consulting organization based in Portland, Oregon. We've got consultants and team members all over the country. I'm here in Austin. Max is back in Portland, where our mothership is, the office is. But we focus on helping independent advisors value, buy, and sell their businesses. And what's kind of cool is over the last, I've been doing this now almost 2 decades. There's been a pretty gradual but consistent shift in the industry, shifting from sort of this production mindset, which is not bad. It's the lifeblood of any of our businesses. I get it. But shifting to treating you all more like business owners first, advisors second, or at least 1A and 1B. And I would tell you for the first 10 years of doing this, it was advisor first, business owner second, but only because there wasn't a third option. So it's been really cool to watch that evolution and to have conversations like this today where we can have questions from you all premeditated and sent in where you're curious about this topic. Like, not just, can I sell my business? And if I can, what value, what multiple, but going deeper than that, like, how do we be really intentional about this? And so that's our focus here today. And as you'll notice, the genre of the things we do, we'll help you exit your business. And it's down there at the bottom. It's sort of the safety net. It's the one thing we all have in common, is we are all leaving the industry at some point, horizontally or vertically. It's common. So, but so much of the work we do and the conversations we'll be having today, it's not even just about building value or understanding value. It's almost more holistic than that, creating a sustainable business, a business that could outlast you. I tell you, that is not easy. It is the focus of our conversation today, but it's also kind of the core of a lot of what we do on improving the practice, protecting it, growing it sustainably, and then making sure when you do exit, you leave Gen 2, whether they're on your team or it's a peer, you leave them in a position to take it even further than where you got it. So that's what we do in a nutshell. We've been doing it, for a long time. We got a lot of really smart people here who are excited, frankly, to work with you when the time's right. May not be today, but it's probably soon. I am, as you heard Max mention, David Grau Jr., President and CEO of Succession Resource Group. I've been doing this for a while now. And like I said, it's really cool to see this topic shift from, just conversations about multiples to where we are today. Like, yeah, we'll talk about multiples a little bit, and they'll come up certainly more in our annual review because we do like to keep that information front and center. But today I get to go deeper with you all and have you sort of back up from working in your business. And for the next 40, 45 minutes, we get to work on your business. So let's start with the questions that you all had. I'm going to, for now, pause the screen share and make sure I've got your questions. If you have any submitted, and I'm going to tackle the first one that was sent in. I rearranged them to sort of ease us into the topic. So the first one that was posed was, what are the top 3 things that we can do on a daily basis that will build more value in our practices? And so I tried to break this really into sort of 2 different groups. So I'm going to cheat since I get to answer the question, but I am going to give you the top 3, but I'm going to give you sort of a level 1 and a level 2, kind of the basics of what you'd expect an answer to look like. And then we'll go a little bit deeper. So the first one, kind of the surface level stuff that it's important, it's impactful. Number 1 would be recurring revenue. Fees, even trails, 12B1s, renewals, to the extent that they're transferable, which can be tricky depending on the system carrier that we're talking about. All of those things, the recurring revenue is going to be a major value driver. I mean, when you look at the multiples, which again, I told you we're not going to be focusing on that today, but I mean, if you figure the multiples are 2 to 3 times on the recurring side versus the transactional side, recurring trending up, non-recurring has been trending down for the last couple of years as a multiple goes. Recurring revenue is an easy place to start. Now, I wouldn't say necessarily being 100% recurring is likely to ever take place unless you're being very intentional about that, because you may have events where your clients need a term insurance or something to the extent you provide services like that, or tax preparation, bookkeeping. Again, lots of different service offerings. I get it. But the more we can be trending towards 85 to 95% recurring, that's kind of also what the market is looking like on the M&A side, what they're looking for as potential buyers. So number 1, recurring revenue. Number 2, profitability. I would not recommend, if you're thinking about selling the business at some point here in the near term, don't necessarily think about going out and cutting your overhead, but know your numbers. And if you can, if you've got a couple of years before you do decide to think about exiting, whether it's internal to your team or selling outright, the other consideration here would be knowing your numbers and working to eliminate the extraneous stuff over the last 3 to 5 years. What you don't want to do is go in and just wholesale start cutting costs in the year before you decide to put your practice up for sale or to sell it to your team members. Because the first thing anybody doing due diligence is going to do is ask for your financials. And when they see your profitability, last year was 30%, and this year it's 75%, they're immediately going to start digging deeper and trying to figure out, well, what's going on. And the problem is there may have just been a lot of extraneous expenses, but where we oftentimes see this happen is you've got firms that are growing steadily, consistently, and outpacing the market, which is awesome, especially from a valuation perspective. And then in the year or 2 prior, they start really reducing their overhead to also optimize the business in another way. Trouble is, as a buyer, if I come in and see what you were spending and what you were driving as results, profitability and growth top line, and then I see you made some pretty significant changes here in the last 6 to 12 months, I'm going to call into question how much value I really put back in that growth category, because you may have just undermined that sustainable growth long term. So recurring revenue, profitability, and KPIs is another easy one. Like some of the key performance indicators I would say keep an eye on: revenue, AUM per client, know that number, do some client segmentation if you need to go deeper on that. But this is where evaluation periodically can be a real value add, because a lot of folks I talk to at conferences, I think they generally think they know basic things like their revenue per client because they know their account minimums. But it's not until they actually do the valuation that they realize all of a sudden, well, shoot, I really had no idea, that I was looking at a revenue per client figure that was that low, or shoot, sometimes it could be, I was surprised that it was that high. So there's a lot of different, KPIs that you can track, but I would say revenue and AUM per client is an easy softball one to start with. Profitability per service model, a little harder to track, but we've got some cool tools that we can share with you. Just a simple Excel spreadsheet model where you can start plugging in some of these figures and just see sort of ballpark. Is your A, your B, your C, and your D clients. Are your A clients your most profitable? I've had a lot of clients that have played with this tool that we built, and they come back and said they were quite surprised that their B clients were actually their most profitable, which is surprising. But again, you don't know if you don't measure. And it's that old Peter Drucker saying, I think the management consultant, he's got a lot of quotes, but one that I love here that you will hear me say before, and you will hear me say it again, is what's measured improves. So do that client segmentation, look at that profitability per service model or per client segment. I think you'll find some interesting trends, or frankly, just reaffirm what you thought you already know and give yourself a pat on the back. So that's the basic stuff: recurring revenue, profitability, track your KPIs, really easy ways to help drive the value of the enterprise. Level 2, sort of the more advanced stuff. I would group all three of these things into building a sustainable business as my kind of overarching advanced topic on building value, which is frankly the topic for today: building enterprise value versus just book value. So number 1 is growth, but I would generally otherwise have put growth into the basic category. And I'm not moving it here to the advanced category because I told you that I would provide the 3 that were asked for. I'm putting it here because when I say growth in this more advanced category, I'm talking sustainable growth. That ain't as easy. So when I say sustainable growth, I'm talking more specifically about trying to figure out, can we build a business that can grow independent of you? Like, is that possible? And that is a major challenge that I see with a lot of folks that we work with, that we do valuations on, is ultimately when they come back to us and we're talking about succession planning, for example, topic we talk about a lot. The challenge they start to run into when they think about selling the business to Gen 2 and Gen 3 on their team is, they're responsible. They're not great salespeople. They can't grow the business. If your business's ability to grow in your absence is dependent on a single person or individuals, then we haven't done our job as owners and founders. We need to build a business that, as you take your foot off the gas, can continue to grow and succeed independent of you and your relationships in the community. So I'm talking about sustainable growth, like could be consistent referral sources, so good COIs, not just your friends and colleagues, CPAs and attorneys that you have great relationships with, but that you can build into the firm as a relationship. I've seen folks do this through radio shows, podcasts, which I'll bring up again later. But again, podcasts can't just be you, or again, in a personal service business, you're already the stars in the show. So building sustainable growth is one key component. It's not easy. It's pretty rare to see it done, but it adds a ton of value when you have it. Sustainable service, again, same thing. Here I'm talking about as a key value driver, top 3 things you could do as the more advanced stuff is kind of like the growth component, but build a business that doesn't need you. That's it. As in, stop seeing clients. If you are the owner founder, you may not be able to do that right away, but if you're the owner founder, try to build a business that can service clients, that can grow independent of you doing it all or you doing it partially. Gradually work to ramp that down. Can your team take care of the clients? If they can't, be intentional about it. Build the organizational plan so that, let's say, 5 years out, if that's your goal, or 3 years out, if that's your goal, 12 months out, I don't care what the time frame is, but set a goal and say, okay, by 3 years from today, given that I want to be retired by year 5, for example, like I need to train my staff, I need to staff accordingly, hire folks so that they can service my A clients, my B clients, my C clients. And that may take time. It, in many cases, may take a decade or more to get there, depending on the size of your firm and your timeline. But sustainable growth, a service model that can operate independent of you, stop seeing clients and be the CEO. And the last one is building a multi-generational firm, because that's going to build a multi-generational book of business. And at the end of the day, it's nice to talk about recurring revenue and profitability. But the thing that you have that has value here, it ain't recurring revenue. It's not even your profits. Those are all sort of derivative of the relationships, the clients that you have. And that's your most valuable asset, is your client relationships. And so I would say focus on looking at things like your average client age, look at your demographics. And so the recommendation here is build a multi-generational firm. Whether you've got folks on the partnership track or not, if you as the founder are 50. Well, we need a Gen 2 who's 40. We need a Gen 3 who's 30. We need them capable and competent and credentialed. If we can do that, you'll find over time, you'll end up with a multi-generational client base, almost without even having to try. And if you try, you're going to get even better results. So I know that is a long answer for a short question, but it's kind of a big question, and I was excited to start with it. So the next one we had is, what affiliation model will produce the most enterprise value? Example provided: RIA, IBD, hybrid RIA, or IAR, or does it not really matter that much? So I put this one here at the top, again, not to give myself a softball. This is actually kind of a challenging one. And while I answer it, again, if you have any follow-up questions for anybody listening in today, do feel free to use the Q&A panel. I will be keeping an eye on that throughout the session, as will Max, and we'll make sure to get to those questions. So to get to the affiliation model question here, it's not an easy question to answer. So again, which affiliation model will produce the most enterprise value? RIA, IAR, hybrid, IBD? The easy answer here is RIA, right? I mean, since you don't have the override, the haircut every year, the RIA's argument would be, well, we start with 10%, 5% more revenue every year. In some cases, that might be true. But I mean, to be fair, to counteract that, we know the RIA has to spend their money on compliance, research, things like that the folks under the IBD model or even the duly registered model just don't have to do. It's already built into that payout arrangement. So the simple surface level answer is, yeah, RIA for sure. But I got to tell you, if things like organic growth or inorganic growth, like M&A is a priority for you, RIA fee only is not the way to go. I mean, it's not a bad way to go, since there's plenty of businesses out there that need help with succession planning. But if we're talking about the pool of candidates, to use nice simple round numbers, there might be like 40,000 independent RIAs out there. When you talk about the folks that are operating under a IBD, I mean, we're talking like 400,000 folks. Now, I acknowledge there's a lot of home office staff, really small producers that just don't matter, kind of from a rounding perspective. But even when we said 200,000 or 300,000, we're talking about hundreds of thousands versus tens of thousands. So affiliation model to produce the most enterprise value, I would say, is probably either hybrid or duly registered. I mean, it's the larger market on the M&A side for sure, which again, asking a barber if you need a haircut, we do M&A. And I think that's a pretty important growth component, especially over the next 10 years. We're seeing a lot of industry consolidation. There's going to be more. And not in a bad way, but there will be more. So having a model that can accommodate the variety of different structures, sellers that are out there is not a bad thing. You also have hypothetically the ability to drive greater revenue per client than the fee only RIA does if you're under the IBD, duly registered, or hybrid model, because of the various products and solutions that you can provide. So I would say in general, probably hybrid or duly registered. It also is, somewhat dependent on size. I mean, it's no question if you're a $400,000 or $500,000 producer, not RIA, not a chance. It just doesn't make sense financially. But as you start to get up to some of the really, large firms that I see that are still under an IBD that are duly registered, you can make a case if they wanted to take it on that they might be better off from a value perspective to go, fully independent. But again, there's pros and cons. That is not an easy question to answer. But I'm glad you asked it, because it is one that we talk about at a lot of conferences and meetings. So next one here, we appreciate your thoughts on prioritizing paying down debt versus reinvesting in growth to maximize enterprise value. It was an interesting question, and one we don't get actually all that often. And it's great timing, frankly, in the lovely interest rate environment that we are in. So the short answer here is, assuming it's that you've had on the books for a little while now, I'm going to guess that it's probably at a pretty reasonable interest rate by today's standards. So, kind of like when you're growing up and you've got student loans, but they're at such a low interest rate, it'd be nice to have them paid off, but you might be better off putting your money to work elsewhere. I think the same thing applies here in most cases. So I would say investing in growth. especially, right now, and there's so many opportunities. But then the question is, well, okay, so growth, but what do you spend your money on? Well, I mean, I got to say M&A is worth spending some amount of time and effort on, inorganic, be looking at our site, be looking at other competitor sites that list practices. Just keep your ear to the ground, spend some time, which is money at the end of the day, talking to your favorite wholesalers, your least favorite wholesalers. If you're an RIA, talk to your custodian, your relationship manager about your interest in acquisition. I think it's worth spending time there. And then other things, again, back to the sustainable growth, invest in those sustainable growth sources, whether it's time or money or both. Can you develop either a team that can help you grow, a seminar series, a radio show? I mean, I got to say it's a weird thing to say in this industry because we haven't spent a lot of time, and most advisors don't spend a lot of money on it either, is marketing. Like, as any other business owner in America, it seems really weird to think that you all don't spend that much time or effort on marketing or money. But I think those that do make the investment, they get the return, not short term, it's marketing, but long term, it's worth investing in. So we were on a call yesterday with FICOM, awesome group. I think a PR firm, an agency can be an amazing resource. Outside perspective, ideas, strategy, and guidance, because none of us are generally marketers. Some of you listening might be, but I'm certainly not. So I think a PR firm, an agency, someone like them can be a great resource. Starting a podcast. Every time I talk to Matt Holleran over at Proudmouth, I get excited, and I don't want to do a podcast, but every time I talk to him, you'd think I did. I think, and again, Proudmouth's focus, as an example, just because I've known Matt Holleran for a long time now, their focus is actually on helping advisors put together podcasts. I just talk to them because I know them and like them. But I think that can be another great resource that is easy, helps differentiate you. And it actually ties in with a question I'll get to here a little bit later. But I think marketing is a great place if you know how to spend the money. And if you don't, like my example before of somebody like, FICOM and other firms out there like that, find an agency that knows this industry that can help you. You don't have to be a marketing expert. You just have to be good at finding people who do know about these things. So that's where I would spend my money. Leave the debt for another day. Sorry, Dave Ramsey. Number 5, 4 or 5 question that we had here. So this one was another fun one. So we've got a small practice that'll be selling in 3 to 6 years. Do we have a minimum size, sort of valuation that we work with? So not specifically is the short answer here. So when we talk about on the sell side, yeah, I mean, I get it. It's also partly price and fees. Our fees could price some folks maybe out of the market where you just don't want to spend that money, but we can deliver most of these solutions pretty cost effectively. And we have tiered service models. So generally I would say no, we don't have a specific size or minimum necessarily. On the sell side, I would say we've got buyers in our system that are looking for RIAs with multiple billions of dollars in assets under management, and they'll look below that, but that's kind of their target sweet spot. And we've got other sort of first-time buyers, or maybe they bought before, but they're looking for a small book of business that'll generate 50 or 60,000 in GDC under an independent broker dealer, buy some of these C&D clients, and everybody in between. So you'll see from time to time, we will list firms with, hundreds of millions, $1 billion in AUM. We'll list small partial book sales. It's more about making sure you find the right fit, agnostic of size. So, and that's true both in partnering with a firm like ours, but also when you sell, finding the right person who's going to honor your relationship with your clients. So no specific size, fees obviously is always a factor in a consideration. And if you're curious, shameless plug, since it's my webinar, you can check our website. We have all of our fees up there. I mean, we'll do some enterprise consulting and things like that. That's a little bit more outside the box for bigger firms, more complicated stuff. But otherwise, our valuation, our deal making service, succession planning, even mergers, which can be kind of complicated. All those fees are out there so you can see them. Next question here. So I've got a hybrid commission fee-based business. How can I best improve the valuation of the commission-based component? So the, again, easy answer here is convert the commission-based dollars to recurring dollars, but let's go beyond the basics. Try to make the non-recurring, the commission-based stuff as recurring as you can, is the short answer. And there are there are practices that I have worked with over the years that they're all commission based. I mean, you don't see a lot of it anymore, but there's still some holdouts where it's all individual stocks and bond trades. But when you back up and look at their revenue, from 5-10 feet away, you never know it was commission based. It's pretty consistent. It's pretty recurring, even though it's commissionable. I mean, it's time of sale stuff. But if you can show a buyer a historical track record, you may not get to a recurring multiple necessarily, but you can at least get it out of the zero multiple category, which really, I mean, you think about the commissionable business. We get this question from both buyers and sellers for very different reasons, as you might guess, or at least they're expecting very different answers. The buyers are asking the question, what's commissionable revenue worth? Assuming the answer is going to be zero, and they're not wrong. Commissionable revenue, it will not come in next year. At least those dollars won't be repeated. And unless you as a seller plan to give them the commissions you just earned this year, it's not worth a lot to a buyer. On the sell side, they're going the other way with it, saying, well, yeah, but I generated $100,000 in commissions last year. But the year prior, I did 90,000. The year prior to that, I did 105. The year prior to that, I did 110. The year prior to that, I did 85. Like, we can see a consistent trend, and it's trending in the right direction. So I would say understand that if you generate large commissionable activities and they're inconsistent, they are worth nothing. Buyer's not going to pay you anything for that. But if you can show some level of predictability, then there's some value in it from a buyer's perspective. So I think on the sell side is approach it sort of like you would if you were in the buyer's shoes. Like, would you pay anything for this? If you can demonstrate the ability to grow it gradually over time and that it's relatively consistent, then it can be worth paying for. And I don't care if it's new sales to the existing client base, that's great. But even if you can show them you have the ability as a marketing machine to bring in new business and generate these commissions consistently, but you have the track record and the way that you grow and generate those new leads is sustainable and transferable, that's how you build value into the non-recurring. Otherwise, start by assuming the non-recurring is worth nothing. The buyers aren't wrong on that question. Jill had a question she had posed in the chat on what's the average multiple, for practice and what it's selling for. The average multiple in 2021, which now feels stale given that we're in 2023, was 2.83 on recurring and 0.8 on the non-recurring. I could give you a really educated guess on the 2022 figures. We have not finalized them yet. And we've got a few more data sources coming in with some data. So Max will be sharing the date of that webinar again at the end when we wrap. You can probably even drop it in the chat for everybody if you're watching. But we do have our upcoming annual webinar, Jill, that we will be actually publishing that, and then a plethora of other data, deal structuring trends, what's been happening out there. So we are excited to share that with you here. So more to come. As a preview, I would say in general, the multiples have been trending up slightly. They were doing really good for the first half of last year. And then the second half of the year happened, or at least Q4 for sure. But Q3 wasn't superb either between interest rates and the markets. So that stole a little bit of our momentum, but there's still a ton of demand out there. So things still did okay, but more of that to come here towards the end of this month when we do publish all of that. So that covers the commission-based component. Next question here that I had is, when should I hire additional staff? So when should I hire an additional staff person versus partnering with another owner in the business? Again, kind of a challenging one here, a good question to be fair, but a challenging one nonetheless. So when we talk about the addition of a staff person versus a partner, I would say in my mind, two entirely different issues we would be solving for. And by that, I mean, if we take the first one and we say hiring as opposed to adding a new partner, in my mind, you hire to support expansion. Partnering can do that too, but I would say in general, we hire to support your growth or at least your planned growth. Downside is here, adding a partner, generally, I don't say easy, but once you find somebody that have a high level of trust with, the risk is low. Oftentimes they bring a book of business, you combine your respective books of business, divide up the equity, and we go forward now together. you're not out any additional money necessarily. And hopefully you've got some additional intellectual capital. You'll grow faster as a result. Hiring requires you to make an investment. And the goal here is if you're going to go hire somebody to help you grow, as opposed to, partnering with somebody, you're going to be making an investment. And the hope here is that if we had to pay, I don't know, let's say you got to pay $80,000-$90,000 base salary to bring on, a paraplanner or somebody who's licensed, capable of doing some service work for C&D clients. Maybe they have the potential to generate some business, but making that investment, the goal here is that with those additional hours that you can push work to them to fill up their bucket of time, their 40 or 50 hours per week, and that the newfound free time that you have can generate more than, let's say, I'll go the high end, the $90,000 you just spent, which the answer should be undoubtedly yes, that is worth the investment. Because let's take simple math here and say $90,000, maybe 80 base salary, but 90 with benefits and everything else, works out to about $45 an hour. If you can't do activities with your newfound free time that generate more value than $45 per hour, we're doing something wrong. So I think, investing in the business is definitely a worthwhile activity. When I say investing, you'll notice I use the example of hiring somebody and paying them a salary. Don't bring them on and do revenue splits. That's the easy way out, but it will cost you in the long run. Bring them on, pay them a salary. When do you do it? Which is obviously the core of your question for the individual who asked this. I would look at your clients per professional. And it's going to vary a little bit, but I would tell you kind of the sweet spot, and it'll depend who you ask. But if you really dig deep into the question, the consistent answer is usually like 90 to about 120. Again, depending on your service model, the size of the clients, product offerings, everything else, your account minimums. But if you figure the safe sweet spots, kind of 90, pushing 120 on the high end on clients per professional, for most of you starting out, you'll get to 150, 200 households, and then you're going to have to hire somebody, and you're going to have to hire somebody pretty quickly because you're getting bogged down by everything. But I would base it on, your staffing levels, your number of clients per professional. When that gets out of whack, whether it's just you or a team of 10 or 12, when you start to have too many clients per professional, we need that farm team of talent. We bring on that 30-year-old CFP, couldn't close business to save their life, and we don't need them to. We need farmers usually, not hunters. So on the answer here, hiring is about supporting that expansion. I'd say, target, again, back to valuation. And there's other benchmarking tools you could use, but valuation's a good one. Get the business valued, get the KPIs, and see what the average number of clients per professional is for a business like yours. And then see where you stack up. If the number ends up being, 65, given the type of clients you serve, and you're at 95, that's good to know. You can do something with that information. And it could go the other way too. But if you don't know, it's hard to manage. The partnering component is, in my mind, that's not necessarily about adding more time. More time you can buy. You don't have to give up equity. And again, this is Succession Resource Group. We deal with equity sharing, equity management-based solutions all the time. It's kind of our bread and butter. I would say be stingy with your equity. Don't give it away unless you have to. So, but adding a partner can be really good, from like adding additional talent and skills that you don't have or designations, tapping into a new market, be that geographic based, or again, maybe, you want to start tapping more seriously into the retirement plan space, but you don't spend a lot of time there. Partnering with someone there could be a great opportunity, and do some cross-selling with the CPA could be a good example. So I think all of those can be great reasons to add a partner. New market, new skills, new talent, but I wouldn't do it to solve a service issue. And again, same thing, if you're going to bring somebody on who has an existing book, great. But just because they have an existing book doesn't mean they get to be a partner in this firm. We might give them a better payout, better bonus, might give them some kind of grid-based payout on their clients that they brought to the firm. But be really careful about, making people partner, promising it, or even implying it. A lot of the work that I do around being an expert witness at trial or arbitration is because people, sort of made these overt, or sometimes very specific promises, or at least created the intent of sharing equity with folks. And then things just didn't end up working out. So be really careful with the equity and the partnership stuff. Next one gets a little bit more micro level here. And that is, this person's wondering, or I'll just read it. I'm wondering what a CRM does specifically to value Redtail as opposed to like the BD CRM. So obviously somebody under a BD, but custodians sometimes provide these things too. So what does this CRM system do? I would say on the surface level, again, we'll start there and we'll go deeper together and peel the onion back. The CRM by itself doesn't do anything for the value of your business. However, asterisk on that statement, because we've been to conferences. We're next door to the people at Redtail all the time. We get to talk to them about how their CRM impacts the value of businesses. It does, but it does it indirectly in a different way. So if you use the CRM system as a good example, so if you buy the CRM system or the BD gives you the CRM system, that doesn't do anything. In fact, it might hurt you if you have it and don't use it. But if you have it and you use it, maybe even use it to your full potential, I hesitate to say, what you'll generally end up seeing that our evaluation team can measure, which is what matters, what a buyer can see, what our evaluation team can see, is how is the impact of that CRM system manifested in a measurable way? So things like greater efficiency as a result, not a crazy thing. If you're using your CRM system, you've got workflows and processes built in, everything is documented, it's all in one place, some automated, if you will. You're going to need less staff. You're going to be more profitable. You're going to be more efficient. You can have a better and more consistent service model. Again, back to like the workflows, for example. If you have your workflows and your onboarding process for new A clients, B clients, C clients, and D clients, it's going to be a lot easier for you to manage. You're going to deliver that service a lot more consistently. Well, guess what that's going to drive? Probably better retention of your clients. You may even end up with more referrals because not a lot of people are doing this. So the other one is then back to the M&A side. Makes due diligence so much easier if you have good record keeping and it's all in one place. So in general, does the CRM system impact value? Not directly, but does it impact value? Yeah, kind of. If you use it and you use it properly, it most certainly can and will. Then you get down to, well, which one drives value? That varies. I mean, you'll see it even, like I said, in the valuation, when you go through and do evaluation and you're using a CRM and we compare you to, 50 other firms that have sold that are of similar size. If you're using Outlook, that has been an answer, and you see most firms of your similar size are using Redtail or Juncture or whatever it might be, that's really good to know. And it's really good to know before you're ready to retire, because you can do something about that. The other component is like the example that was asked was Redtail as opposed to like the BD CRM. Avoid proprietary CRM systems if you can help it, unless you are with in this case, a BD that is large enough to have a robust and willing market, which we have seen before. I mean, there's some firms out there where they do have a kind of internal proprietary system, but they're a big enough BD with enough advisors who are active on the buying and selling side that it doesn't have any impact at all. But I've also seen, some smaller, more regional based firms that built their own version of another CRM system, and the folks inside use it. The trouble is, being with a smaller independent firm that maybe not as many people have heard of. There's 75, 150 of you, I don't care, 300 or 400 of you nationwide, and you're using a proprietary BD supplied CRM system, that is going to hurt your value, like undoubtedly. So again, because the whole goal here is about transferability. And you could say, well, yeah, but I'm going to keep it within the network. Well, sure. But if your network is 300 potential people total nationwide, they are not all going to be interested in your practice or even capable. So that pool goes from small to really small, which in my example, we know of a couple, big national broker-dealer RIAs that they do have an internal proprietary system, but there's thousands of advisors and they have a really robust M&A market. So frankly, using the same system that everybody else uses is actually a value add. So it can be a complicated question to answer. But again, these are the questions you want to be thinking about and asking before you're ready to list with us or have us help you broker a transaction. Because at that point, it's interesting academically, but there is not a lot you can do about it. If you start approaching this topic earlier, certainly if you do evaluation, you'll find this stuff out. But even just starting to ask questions like this in a webinar like this, you can start to make some meaningful strides to driving greater value. So the next question here is, could we provide some information on earnout structures compared to traditionally financed buyouts and how that affects the multiples? Again, I prepared a couple, bulleted responses here to make sure I didn't get off track and hit everything for you. So on the topic of earnouts, it's a good question to sort of push the concept of how value can be impacted by this deal structure to its extreme. Because for those of you maybe not familiar with an earnout, haven't used it, haven't really heard the term, it's a term for making performance-based payments. And yes, John, thank you. These are great points. I appreciate the comments there. So when you start thinking about earnouts are a performance-based way to pay, where I basically would say, I'll say use John on our team. So if I pay John, I'll agree to pay him a 1.5 times multiple, but I'm going to do it on an earnout, which would look something like 30% of the revenue for 5 years. Shared risk, shared reward. This could be fantastic. It could be an utter disaster. We'll know at the end of year 5, because again, it's performance-based payments. So when you think about how deal structure impacts value, it is not how long it takes to get paid. In the earnout, to some degree, but if I'll pick on John again, if I was going to sell John my business, but he was going to pay me on a 5-year promissory note, the value doesn't change. If he was going to pay me on a 10-year promissory note, the value doesn't change. He's going to pay me interest. That accounts for the risk of me having to wait to get the money. If we have an earnout, if we have a promissory note with a clawback built into the deal, that changes the risk profile. There ain't any amount of interest that's going to make up for that. And it is pretty common nowadays to have a clawback built into the deal. I mean, more than half of the deals have a clawback, which is kind of like an earnout, but a clawback is usually a one-time reset. So usually at like the 1-year anniversary, we would agree, we will look back at the prior year. And if I, as the buyer, have retained 90% of the clients or more, then nothing changes, no adjustments made. But if we're below 90%, we're going to reduce that purchase price. When a clawback is built in, when we use an earnout, like the question was asked here, we are shifting the risk from one party to the other. When that happens, the price changes. So in the question here about the earnout affecting multiples, I mean, let's say that if the average multiple was 2.83 in 2021 on recurring, that would assume that I was going to pay you with the 1-year look back, because that's pretty consistent. It's a fair assumption to make. If the buyer comes back and says, well, yeah, but David, I don't like the risk in that. So how about I do an earnout? I'll still pay you the targeted 2.83, but I want to do it as a percentage of revenue over 5 years. Again, time frame's not super important, but it's a percentage of revenue paid out. Well, now all of a sudden the multiple, to put the risk profile back to where it otherwise would be sort of in the middle, the earnout shifts all the risk to the seller. As a result, I charge a premium. So when you hear deals out there where a seller talks about getting a 4x multiple or a 5x top line revenue multiple, a lot of times that's when they're selling based on an earnout, because it is purely pay for performance. The other component is buyers love earnouts because they mitigate their risk. Also, they're generally taxed as ordinary income. It's straight up revenue sharing. So there's ways to sort of structure the deal that we can get CPAs to treat it differently, as capital gains. But there, this probably as well as we do, there are 2 types of CPAs. Those that are really good at what they do and clients like them. And there's those that are really good at what they do and the IRS likes them. And one or the other. There's not really anybody in between. So, and frankly, I would say being married to a CPA, most CPAs, it feels like they actually don't work for you. They work for the IRS. So you want to keep in mind the taxation of an earnout. So there's the risk profile, there's the taxation. We can do something about the taxation sometimes. There's not a lot we can do on the risk profile, aside from, as a seller, increasing the price to offset the risk that I'm now taking on. So generally, you're going to see higher multiples, is the short answer, and significantly higher multiples, generally speaking. So next question here, what happens if I can't find a buyer that I like? I would say in this market where there's generally, 40 to 50 conservatively, 75 to 100 buyers per seller. If you can't find a buyer you're like, your business is either really unique, which usually it isn't, or you're just being too picky, which is fair. I mean, we're all going to be there someday when we sell our businesses, because most of the sellers we talk to a lot of them, big and small. Mostly what they're looking for is somebody who's just like them, just 10 or 20 years younger. Problem is that doesn't generally exist. And when I say just like them, I'm talking down to like political affiliations, sexual orientation, maybe go to the same church. Like that's what sellers are looking for, which is fair because again, they have an asset that is worth a ton of money, but that asset has the ability to vote with its feet, their clients and their relationships. So I get it. It isn't lost on us. So I would say start by understanding, try to focus on the core of what your clients actually need. We've got a great practice right now in Iowa, as an example. They're in the Midwest. And they, of course, they want, local presence. Do the clients actually need a local presence? We get that from sellers all over the country. And they say, well, yeah, I mean, undoubtedly, we got to have an office here. Like my clients are just used to that. And you say, okay, well, how often do you meet with your clients like face to face? And say, oh, usually, once a year, maybe twice. Okay, well, how many random drop-in appointments do you get? So never. I mean, it happens occasionally, but really never. So could a buyer not come into town 2 or 3 times a year in the first couple of years, do some of that, sort of surge meeting schedules where they knock out a whole bunch of meetings at once, have dinner with some of the top clients, then go back home? Like, yeah. So I use that as one example, but start by understanding the core of what your clients really need. What is important to them? Can we clone you? No. But there is a fair amount of buyer demand. So you can be picky, but just don't be too picky. And by that, I mean, the pickier you get on the buyer requirements, where you basically paint a picture of you 10 or 20 years ago, you take a ready and robust market that wants to buy your business, and you start to just whittle it down to like 3 people that might exist in the US. And we're hoping we can find those 3 people. Sometimes the description that sellers give us of what they're looking for, statistically, it probably just doesn't exist. And the problem is, even when you then make some concessions, you've narrowed the pool of potential candidates down where you may be missing an amazing candidate for your clients because you want them to, use the same third-party money manager, or you want them to have the same billing in arrears versus in advance. Like that shit doesn't matter. Like it's nice when you can find it, but you got to focus on the core stuff, honestly. And that's what's going to be most important to your clients, and it's what's going to drive retention. So I would say start with that. If you can't find a buyer that you like, it's also partly then, well, what did your search consist of? Because we run into this a lot where I'll talk to folks at conferences and it'll be an advisor, guy or gal who's, in their mid 70s. And they said they've looked around the last couple of years and they just haven't been able to find anybody, good, qualified, and capable that was interested. I mean, I would tell you, if you work with a firm like ours that, we have a team dedicated on the sell side that can go find these candidates. I mean, frankly, we already have thousands of potential buyers. You don't need thousands, though. It's about finding the right one. Just make sure, whoever you work with in this process doesn't leave any stone unturned. I mean, that's where like the downside to like a bulletin board, non-advocacy system where you can just post your practice up for sale is you need somebody going out there and shaking all the trees. And that takes time and it's not easy, but it is a core of what we do. You can do it too if you've got the time. Again, talking to wholesalers, home office staff, field leadership. I know we know a lot of folks like Asset Mark. They'll call and talk to their relationship manager there. They're great about helping with that stuff. So there's a lot of demand for practices. So be picky. I get it. You do want to make sure your clients end up in the right hands, and that's what's going to drive retention. Just don't be too picky. So, and if you do start too picky, gradually back those things off until you find somebody. Next to the last question here, do smaller firms have any hope of purchasing other firms? Well, I won't mince words. I mean, not really, no. But small is also a relative term. I mean, I talk to folks at conferences who have $1 million RAA and say, do we even have a shot? Yeah, relatively speaking, you will do just fine. If you got, $100,000 in, fees or $100,000 in GDC, No, probably not. But I wouldn't say that means you don't give it the old college try, because there is still a chance. So again, I said it's about fit. So, but seller also has to be willing to take a chance, on who the buyer is, in which means case they're going to want to see some demonstrated success usually. So 5 points we usually talk through with folks. Number one, build something that a seller would want to sell to. Like, I don't care about the size of the firm necessarily, but your processes, your investment strategies, I mean, have that elevator pitch ready. Why did your last client or the 10 clients before that, why did they pick you? If you don't know that, that's worth ruminating on. Or again, going back to the agency conversation, like, find somebody who can help you ferret and tease those things out. It ain't easy, but have the elevator pitch ready. Know what makes you unique in the space. I mean, I think that's a really important component, so that if you do end up finding a good potential lead, you're ready to articulate that. It is about fit, but they don't know you in many cases. So how can you make sure they get to know you quickly? The second one here, there's a lot of smaller lifestyle practices. So, however you define, a smaller firm, there's probably a lot of other firms of similar size. So knowing that, it's again worth getting active and getting out there. And I would say that's probably, my next one is not terribly dissimilar to real estate. If you're do real estate investing, residential or commercial, I don't care which, try to find something off market. We'll list practices that are smaller in size or partial book sales. And I think there's other firms out there that do the same thing. But I would tell you, you are going to be competing with, even if you're a small firm, there's going to be firms that are 40, 50% bigger than you. And if they're similar in all other respects, the seller likely is going to pick somebody who's a little bit bigger and more stable. But if you find an off-market deal, then it's just you and the seller. It's yours to lose. But it requires you invest a little bit of time and effort, like go to the FPA chapter meeting in your area. I don't care what the topic is, for that month. Go to the meeting, pay your dues, whatever it is, stand in the back of the room, let everyone get seated and look around. Find the advisor with the whitest hair, the least amount of hair, and go sit down by him or her and strike up a conversation. Statistically, if you read any of the trade publications, any of the studies done, our findings are consistent with them all. It's like 1 in 10 advisors actually has a succession plan. And I should put air quotes around that since we got video today. Most folks do not have an actual succession plan. They may not need it immediately, which is why they don't have it, but they don't have one. So I think you can find something off market with a consistent investment of time. Doesn't have to be a lot of time, but a consistent one. You can find deals, in which case then it's just you and the seller. So another one, be the smartest person in the room. Like, do your homework, attend sessions like this. We do a lot of other sessions and have downloadable resources. Know the typical multiples, which we'll talk about here soon. Know how deals can be structured. We have whole series and sessions based on this, many of them recorded. We've got white papers and articles on how these deals are taxed. If you know all those things, when you do find somebody who might even be a lukewarm lead or conversation as a potential seller, you may very quickly find you are the path of least resistance, which is what a lot of these folks are looking for. And last one I would say is, most of these folks, kind of like my response to the other individual who asked about selling the business and not being able to find a good fit, like, most advisors who are selling do want someone just like themselves. So if you've got 200,000 in annual fees or GDC, there's a good chance there's somebody else out there with, 150 to 250,000 in annual fees or GDC, and they don't want to sell to a roll up or a consolidator. And they certainly don't want to sell to the CFP who just, got licensed and got into the industry. So your size may actually work to your advantage in that case. So just keep in mind when you say, do small firms have a chance? When you look at the bell curve, it's not a bell curve. Like, there's just a lot of producers, doing less than 400,000 or 500,000 a year on the IBD side, hybrid side, duly registered, or fee only RIA. So if you are a smaller firm, technically, you probably have a better chance of getting a deal done. It's just from a competition perspective. If you can find something off market, you're going to end up doing a whole heck of a lot better. So I'm going to wrap up with one other, I'm going to call it a question. It's not really a question. It's a situation that, came up here recently, but I'll sort of pose it in light of a question for you all. And that is, what is one of the key things to avoid doing that could impact your enterprise value. So the inverse of our topic today, building, how do we not hurt our enterprise value? Compensation is the short answer. So it's the thing that I will leave you with that is probably also the hardest. If you got employees, dealing with compensation sucks. And we've got employees on here, guys. It sucks as well as I do. It's hard. Everybody wants to make more money. Businesses want to make more profits. It's the nature of the beast. The challenge is for most advisors, historically, it has been very much modeled after where the industry sort of grew up. And to be fair, this has happened before my time, but it's been a carryover. Is you have folks that grew up in sort of that captive wirehouse broker-dealer environment where all the wirehouses were looking for were hunters. They need people who can identify and close business. That's it. And they gave them a grid-based payout system. And then those folks left and went independent, but brought those lovely pay grid compensation systems with them because the IBDs were doing it too. And so then they pay their folks on commission splits. Well, if you use the example we had here recently of a client, so they generated, I want to say it was like 1.4 million in annual revenue, pretty much all recurring, which is great. Value on that thing very easily could have been, 3 point something million, getting precariously close to 4. I mean, it's going to be an on-market sale here probably. The challenge is of the 1.4, about 400,000 of it is paid out as GDC based, or revenue based compensation, where it's on a grid. So $400,000 out the door to pay these people who service their clients. Now it's not their clients technically, the investment advisory agreement is with the RIA, but I would tell you in reality, the way you measure equity isn't who has the contract, it's who's got the relationship. So avoid GDC-based or revenue-based compensation systems. If you're going to build a firm that has enterprise value, you're going to bring people on, you're going to pay them a salary, you're going to pay them bonuses. It's going to be a hard shift, and you may never shift it. You may just start with the next new hire you do this with. But there's no faster way to undermine the enterprise value of your organization than to pay people out a percentage of revenue for clients that they service exclusively. It's dead money. I mean, dollar for dollar, you'd think, but it's not even dollar for dollar, because if you're paying them out GDC based or revenue based compensation and it's all recurring, then in my example, where it's $400,000 that gets paid out, basically that firm's gross margin that has value that can be sold is really about $1 million. Well, let's keep my math simple, a 3x multiple, that puts it at 3 million instead of like 4. That's a pretty big difference with something that could easily, you can't really fix it easily, but it could have been built differently very easily. And that is, I would tell you, these are not amazing insights that we just came up with. We are trying to help lead this trend in the industry, but it has already been happening. If you look at the biggest and best RIAs out there, best is a relative term, but the most successful RIAs out there, this is the model that they shifted 2 years ago. And the rest of the industry now is starting to do this as well, big and small firms. So that's the thing that I will leave you with here. Max, I'm going to hand it back over to you to close us out. Again, maybe just remind folks on the next webinar we've got coming up, where I'll be there, but I'll be mostly moderating. We got a lot of really smart folks that are going to talk about some cool trends from last year.
Fantastic. Thank you, David. So as mentioned, a link to the recording is going to be coming your way shortly via email. We're going to close with 2 key events for you to look out for. Number 1, David mentioned our next webinar is our most anticipated and popular webinar of the year. It's less than 2 weeks away on Tuesday, January 24th. This is our annual advisor M&A review, where our team is sharing 2022 transactional trends and then their expert predictions on what's to come. Registration's open now. You can find that on social media and likely in your inbox as well, your email inbox. The next SRG Off Script is scheduled for Thursday, February 9th. This session is open to topics. So if you'd like to submit topic recommendations, please do so on social or via email, and be looking out for that registration as well. With that, thank you so much for participating today, and we will be in touch with what's to come.
Thanks, everybody.